Welcome back. We are now in chapter 16, and in this chapter we'll be discussing about various credit concepts. Right, the topic of this book is balance sheet analysis. Right, this chapter is not related to balance sheet analysis. Okay, this has got nothing to do with the financials, but these are a list of terms, right, and concepts that as a credit officer you're very likely to come across, right, in your day-to-day work. So just thought I would brief you about this. We're not going to go in detail into each of these terms. Okay, please refer to the book. You do have access to the PDF file of this book. So if you need any further clarification, a complete explanation, please refer back to the book. Okay, so what we'll do here is I'll just take you through the list of topics that are available in the book. Okay, so that if you need any further explanation, you can refer those topics. So this is a comprehensive list of topics, right? The more than 50, right? Around 60, right? So a lot of topics, right? You'll be learning something new from them, right? So please make sure that when you have time, just go through all of these terms, right? You'll be learning something new. So let us look what are the topics that are available under this section. So one thing of the topics is the ICA accounting standards. So the book has got a small little write-up on the accounting standards. See, there are around 32 accounting standards. These are standards issued by ICA. So in the very beginning chapters we discussed about the accounting, what is known as accounting standards, right? There we discussed about ICA, we discussed about GAAP. If you recall those sort of things we have discussed there. So in India, the accounting rules are framed by ICI. This is the Institute of Chartered Accountants of India. Okay, they'll be framing the accounting guidelines. So we have total 32 accounting standards. I'm not saying you need to be familiar with all these accounting standards. That is the job of those who are in the field of accounting. As a banker, you need not be familiar with this. You need not be thorough with these accounting standards. But the point is, at some point of time, while dealing with some particular case or proposal, you might want to refer to some of the accounting standards. Say for example, in case of contracts, revenue recognition will be separate. Revenue recognition in case of contracts is totally different. Okay, in those sort of proposals, you might want to refer to the relevant accounting standard. So in those circumstances, it will be helpful. So I would advise you to keep a copy of all the accounting standards, downloaded in your desktop, downloaded in your office system, right? So as and when you require, you can refer back to these standards. Okay. There are a total of 33 accounting standards, but after AS 26 was issued, this was brought down to 32. Okay, but anyway, the point is you need not be aware of all these individual standards. However, a couple of them are important from a banker's perspective. Like AS2 deals with valuation of inventory. Okay, then we have AS7 that deals with construction contracts. AS9 will be dealing about income recognition. So there are some accounting standards that might be interested to the bankers. Okay, so if you have time, as you keep doing more and more proposals, if there arises a need to look deeper into some of these standards, you can refer to the ICA accounting standards. Then we have a topic on components of balance sheet, a corporate balance sheet. Okay, corporate balance sheet will be having a lot of sections, right? So we have the chairman's message, we have the management discussion and analysis. Okay, there's something called corporate social responsibility statement. Then we have significant accounting policies. Okay, notes to account. So the corporate balance sheet is broken down into various segments. Okay, so since your job as a credit officer is going to be looking into a lot of balance sheets. Okay, if it's a proprietorship or partnership firms, maybe you're not going to see all this. Okay, but for a company, definitely you're going to see, especially for a listed company. Okay, you're going to see all this because you need to go into each and every of this, right? A balance sheet is a comprehensive document, so you cannot just focus on the figures and not read the significant accounting policies or the notes to account. So everything is a part. You have to read the balance sheet as a whole. Okay, so this topic will be discussing these sections in more detail. So please refer to the book. Okay, Tally is a accounting software. So this is a software that is used by most companies for accounting purposes. Just rush through. Okay, I'll rush through these topics. Told you earlier. Any further explanation, you can refer to the book. MC21 is a government portal. Okay, it's a portal by the Ministry of Corporate Affairs. So you'll be finding a lot of interesting information here. Okay, for example, if you want to look at something called search report, you can go to this MC21 website and see search report. Okay, because for some companies, right, before sanctioning, if it's a new company, if you want to know what are the existing charges, whether this company has taken loans from any bank and whether any charges are existing, you can get the search report going to MC21. Okay, so it's a very important portal. You'll get a lot of important information. You can also get the information on the who are the directors, right? Their DIN. So various information is available. Okay. So if you go to the master index, company master data, if you go to the company master data, you'll get a lot of information. So please take time to look at this portal. Then e-filing of balance sheets, as you know, beyond a certain cutoff. So for some companies, say those who have turnover for around 100 crores, more than 100 crores, or having a paid up capital of more than 5 crores, there's a certain cutoff. Okay, they need to file balance sheets online. So this is a topic which might be of interest to you. Format is something you hear a lot in the banking industry, right? There are various forms. Okay. Say form 1 is for declaration of a company, incorporation of a company. We have form 8. This is regarding the creation and modification of charges. Okay. Then we have something, say form 23. This is regarding induction of new directors or creation of directorship. Okay. Then we have something called form 17. This is for satisfaction of charges. This is creation of charges and this is satisfaction of charges. So there are a lot of forms, right? Form 8 is a very important form. Okay. So whenever you sanction a new credit facility to a company, you have to follow up with the company and get the form 8 created. Search report we discussed. There's something called revised schedule 6. Please go through this topic in detail in the book. I'm not going to discuss in detail. This got a good comparison of what is the existing guidelines and what is the revised guideline. Basically, schedule 6 is regarding the format of P&L account or balance sheet. So especially with regard to balance sheet, there are a couple of changes in the revised schedule 6. Okay, schedule 6 of the Companies Act stipulates the format for the balance sheet. Okay, now this schedule was revised a couple of years back, and you as a banker you need to be aware of what are these changes, because if you are in the banking industry in the advances for say more than 5 years, you're going to see a lot of changes in the format of balance sheet, what was say 3-4 years back and presently, right? For example, earlier if a company had accumulated losses, okay, what you normally see was in the balance sheet you have capital, you have reserves and surplus. Okay, accumulated loss basically means reserves and surplus is a new zero. Okay, and there is a negative. So what the companies used to do, they used to show under intangible assets as a positive figure. But now as per revised schedule 6, this is not permitted. You have to show in a negative figure under reserves and surplus. Here itself, so there are a couple of changes there in the revised schedule 6. So please go through this section. You'll have a very good comparison. Then stock in trade, basically we discussed items like raw material, work in progress, finished goods, stores and space, but we never discussed about stock in trade, right? Stock in trade is usually even a companies who are engaged in manufacture, sometimes they can also do a bit of trading. The core activity will be manufacturing, but they can also do a bit of trading. Okay, so whenever you see a term called stock in trade, please classify under stock in finished goods. Okay, it will come under finished goods along with the regular finished goods. You can add it to the stock in trade. Okay, please go through this section. We have further discussion in the book. Then there's something called excess registers, though not very important from a banker's point of view. When you go for unit inspections, okay, you will be going to the stock registers. Okay, because basically you go for unit inspection to check the stock, whether sufficient stock is available to cover the CC liability. Okay, so the company will be maintaining a register of stock. So and the company will be submitting every month stock statements also to verify the authenticity of these figures submitted to the bank every month. The company can submit incorrect figures just to arrive at the correct DP, to arrive at a strong DP, right? So when you go to the company, usually is a practice to check this the figures report in the stock statement with what is known as the stock registers. Okay, then there is something called excess registers. This is a mandatory book. This is a mandatory record maintained by the companies. So you not go into depth about excess registers, but there's something called RG1. So please refer to this section where I have given a brief description on these registers. Okay, so if you go to stock inspections, this is going to be very important, right? So we also have a small section on capitalization of expenses, right? So please go through this. It's going to will provide a very good introduction to the topic of capitalization of expenses. Normally, we've seen that in the P&L account we'll be having income and expenses, right? Finally, we'll have the profit. And the balance sheet will be having liabilities and assets. So the point is sometimes expenses can be capitalized. What we mean by capitalization means sometimes the expense is so huge. If you show the entire expense in this year itself, the profit will be a negative, right? And it's also not proper to show the entire expense, because this expense might the benefit from this expense might come over a period of time for the next say 3-4 years. So in that case, it's not proper to burden the P&L account of this year with the burden P&L account of this year by showing the entire expense during this year. So what companies usually do, some items are capitalized. Say for example, interest during construction. So in a large project, interest during construction is a very large component. So what companies do is they'll be capitalizing this, right? Instead of showing in the P&L account for that year during construction, say the construction period is 1 year, 2013-14. So instead of showing this interest, now this interest pertains to 13-14 because this is during the construction. The company, the project is under implementation. The company is a term loan. Interest is for this year for 13-14. So normally you will show interest as an expense for this year, but because the amount is huge and moreover interest during construction pertains to the whole project. Now project is going to generate revenue in the next coming years. So what usually it is done is it is taken to the balance sheet, added to the gross block, and from then on you will be depreciating it according with the regular assets. This is known as capitalization of interest. So many expenses you can capitalize, say capitalization of R&D expenses, right? Capitalization for marketing and promotional activities can also be done if it's a huge ad campaign. So basically when the benefit accrues, benefit is going to flow over a period of time, you can do capitalization of that particular expense. Okay. So please refer to this section. We have a detailed discussion on this topic. Okay. There's something called bias credit. So what happens is, say the LC due date has come. You are SBI and your party has to make the payment to you, but he's unable to make the payment on the due date. So what the party will be doing is, say from a foreign bank, say for example Bank of India, London branch, or some other bank. So what from the foreign bank, what they do is they arrange the funds. Now this bank will be issuing these funds against what is known as a letter of comfort or letter of undertaking issued by SBI. So SBI will issue a letter of undertaking or letter of comfort in favor of that foreign bank, and this bank will be releasing funds. Okay, with those funds, the company will be paying off that LC commitment. Okay, this will be closed. Okay, using its own funds, it has made the LC payment. So this time will be, say, around 3 to 6 months again, right? So now the company will be having this additional time to make the payment, of course with some interest, but basically this interest will be lower because it will be LIBOR linked. Usually these are foreign funds. So the mechanism basically is the party is going to get an extension of time, right? The bank is not going to be affected because the LC payment is going to be made in time by this bank. Even though the party doesn't make, this bank will be making the payment. So SBI's that LC payment will be made. This party will be getting an extension of 3 to 6 months, after which the payment will be made. Sometimes LCs are rolled over. There are some RBI guidelines. Say for example some 20 million per transaction will be rolled over more than 360 days. So there are some guidelines. Okay, but basically this is the mechanism. So please refer to the section for more details. We also have a short section on SWIFT. SWIFT is a society for worldwide interbank financial transactions. Okay, so if you are into export credit and those sort of stuff, a lot of communication between banks is done through SWIFT. So you can go to the section. So we also have a short section on commercial paper. Commercial paper is similar to OCC by banks, but then this is not raised by banks. Okay, this is an unsecured borrowing and is a short term from the money market. Okay, this is usually raised by companies which have a very high credit rating. You need to have a very high credit rating, and there are also some guidelines like some minimum net worth. So there are a lot of guidelines. Usually companies with very high credit rating get this. Okay, so usually you not come across your bank borrowers having CP unless it's a very big company. Okay. Then we have a small write-up on memorandum of association, articles of association. That whenever you get a company that is new to you, new to the bank, you need to get these two documents. Basically, it will be listing out the scope, right? So what it contains, we have a small discussion on that. We also have a section on appropriations. If interested, if you are a bit interested in the accounting terminology, you can get into appropriation. So basically, like what happens after the profit is arrived in the P&L account. After the profit as account, there will be some appropriations. So this is a bit advanced topic. If you're interested, you can go through. We also have a small a discussion on waterfall model. Waterfall model is not usually, it's not something you'll come across in your banking career, right? You might come across this term in interviews because it's frequently asked. It's a very favorite question in interviews. We have a very good discussion on that. A bit advanced topic, but you're going to understand it. Okay. So basically, it's like I'll provide a brief discussion on this. What happens in the waterfall model is usually in case of large projects, there'll be a main investor, right? This is the person who is investing a major portion of the funds. But maybe the investor doesn't want to operate because there might be another operator. Because operation is a technical issue. Maybe this investor is more interested in providing the funds, right? He's a cash rich party and he wants to just provide the funds. But the actual operation, maybe there's a separate person called operator. Okay, so what happens here is, say for example, this is a project that costs 100 crores. The total fund, say for example, out of this 100 crores, the investor has invested a major portion, say 90 crores, and the operator has invested only 10 crores. Now the investor will not be investing 100 crores because in that case, this operator will not be having any incentive to perform well, because he, just like banks insist on margin, to have the borrower stake. Similarly, this investor has said, you invest 10 crores, I'll invest the major portion. Okay, so let's assume this is the setup. Say for example, if the investor says, see, every year I'm going to pay you 1 crore, irrespective of the performance. You're operating this project, it might generate some profit or loss, I don't know, but whatever it is, I'm going to pay every year 1 crore. So that's not a great way of incentivizing the operator, because he's not going to be very interested. Because whatever he does, right, he'll be getting 1 crore. So there's no incentive to perform very well. Maybe he'll ensure that it's not going to be a loss-making project, but he's not going to be very encouraged to perform very well and earn a lot of profits, because even if he earns a lot of profits, it will go into the investor, right? He'll be getting only 1 crore. So in large projects, in this sort of setup, okay, where there's an investor and operator, investors will be using an arrangement what is known as a waterfall model. So basically it works like this. So what the investor will be saying is, okay, I have invested 90 crores. I want a minimum 5% return on my 90 crores. Okay, that is 4.5 crores, right? So your investment is 10 crores. Say 5% on this is 0.5 crores. So what the investor will be saying is, if you earn a profit of less than 4.5 crores, right? That is 5% of my total investment. Okay, as long as you earn less than 4.5 crores of profit, it's going to be mine. Not going to give you anything, right? The moment you cross 4.5, right, you can take, the moment it crosses 4.5 and it's in the range of 5 crores, between this 4.5 and 5, that is, then you can take your 0.5 share. The moment the profit crosses 5 crores, let us share in the range of 50 or 50. And what basically he's saying is, if the profit is low, you're not going to benefit anything. If the profit is high, you're going to benefit a lot, because we are going to share in 50%, whereas otherwise you have invested only 10%. Look, out of the total project cost of 100 crores, the operator has invested only 10%. But whereas if it performs very well and the profit exceeds 5 crores, then the profit sharing will be in the ratio 50 to 50%, even though his investment is only 10%. Right? So there will be incentive for the operator to perform well. If the project earns very good profits, he's going to get a lot of money with very little investment. But whereas if the project doesn't perform well, he's not going to get anything, right? So let us draw up a small table. Let us look at various scenarios. Now let us assume that the profit is only 1 crore. What happens here is, in this case, since the investor will be insisting on 5% of his capital of 90 crores, that is 4.5 crores, he'll be taking 1.1 crore. There's nothing left, Only if it crosses 4.5, the operator will be getting something. So operator will not get anything here. Even if it is 3 crores, he will take the entire 3 crores. There will be nothing balance left. Operator will not get anything. But the moment it crosses 4.5, say for example it is 5 crores, then the operator will be getting, so the investor will be taking his 4.5, and then there will be a balance of 0.5. This will follow to the operator. Okay. If the project performs really well, say for example it is 10 crores profit, initially the investor will take 4.5, the balance will be 5.5. Then the operator will be taking his 0.5, and still there will be balance left of 5. Here there will not be any balance left. And then at this stage, if any balance is left, it will be shared in the ratio 50-50. So now the investor will get here nothing here, but here 2.5. Project doesn't perform well, only the investor will be getting his money. See, the operator will not get anything. But the moment it crosses a threshold, right, the operator will be getting his income. And anything beyond a cutoff, they'll be sharing 50-50. This could be one of the arrangements. The ratio could be different. But the point is, if the project performs really well, look at this case. If the project performs very well and earns profit of 10 crores. So initially 4.5 the promoter will be taking, then the investor. Out of the balance 5.5, the operator will be taking 5%, that is, will be taking 0.5. Okay. Then the balance 5 is going to be split in 2.5. So what is the total earnings of the investor? 4.5 plus 2.5, right? So that is 7. And total earnings for the operator is 0.5 plus 2.53. See, if it is 10 crores, the sharing ratio will be 70 to 30. The operator will be getting 30% of the profit, whereas his investment is only 10%. Originally, out of the project cost of 100 crores, he has contributed only 10%, but his profit is going to be 30% in case the project performs really well. But if the project doesn't perform well, is not going to earn anything. So basically this is a mechanism to incentivize the operator to perform well. Okay, this model is known as a waterfall model. Why it is known as a waterfall model? You can think of it like as a bucket. Okay, so this is the investor's bucket, right? This is the operator's bucket, and this will be the total, the sharing portion, investor plus operator bucket. So initially, if the water is, you can think of this as water. Okay, the profit as water. You can think of the profit as being as water. So if the water level is very low, right, the capacity of this investor in this example is, the capacity is 4.5. This capacity is 0.5. Okay, this is infinite capacity. So as long as the water level is below 4.5, that is the profit is below 4.5, nothing flows to this below container. No, these are placed one above the other. So if it is filled, it will be overflowing. But here the profit is less than 4.5. So everything will be belong to the inventor. Now the moment it crosses 4.5, say 4.75, then this container will be filled 4.5 and the balance 0.25 will be flowing into the operator, 0.25. The capacity is 0.5, but only 0.25 has flown. So operator will be taking only 0.25. But if the profit is 5, this will be filled. The investor will be taking 4.5 and this 0.5 will be filled. So the operator will be taking his 0.5. So 4.5 plus 0.5, 5. But if the project performs really well, say 10 crores, so this will be filling to the brim, 4.5. This will also flow to the brim, and then there will be surplus to be overflowing to the next container. So 4.5, 0.55, the balance 5 will be flowing, 5 crores. And this will be shared in the ratio of 50-50 to the operator and the, basically this is why it's known as a waterfall model. Okay. So then we have a section on multiple consortium and multiple bank arrangement. Please go through this section. It's very important because some large accounts will be having a banking arrangement as consortium, either consortium or multiple banking. So this is a arrangement where a few banks come together instead of a single bank financing the entire credit exposure. Say 3 to 4 banks come together and finance they'll take up they'll split the exposure. Okay. So that arrangement will be having a lot of specialties. Like there could be a joint appraisal. Right, there could be a joint documentation. There will be a joint documentation usually, but joint inspection of facilities, right? So there are a lot of features of a consortium account, right? There will be a consortium meeting usually every quarter, where all the banks discuss. So it will be a strong position for the banking for the bankers. It will be a stronger position to bargain. If there's any deviations from say sanction terms or anything is not compliant, bankers as a whole can apply pressure. Okay, so this is an arrangement. So please go to the section. Base rate is regarding interest rate. Okay, so I think most of you will know about base rate. Basically it's the benchmark rate. Okay, so earlier there used to be something called BMPLR, but that is dispensed with, and now base rate is being implemented. So this is the rate below which bank should not sanction any credit facility. So please go through the section. A bridge loan we had discussed in an earlier chapter somewhere. Basically it's an interim short-term stopgap arrangement. Okay, so in the interim period, say for example an IPO is under progress, the funds have not yet come in. So in the interim period, a loan can be sanctioned, and that loan will be closed once the IPO proceeds come in. Okay, so you can find details under this section. Companies bill. So this is the latest development. This is not yet converted into an act as on date of the preparation of this video. It's not at the act. So Companies Act 1956 still holds, but there's a proposal to amend that to get the latest. So please keep an eye on the latest developments. Corporate loan. This is the facility. So this is actually not given to small companies. What happens is sometimes if we discussed that there should be sufficient NWC in the system. Okay, we have discussed this. But sometimes if the company doesn't have sufficient NWC, maybe banks will sanction then something called as a corporate loan. Note that this is not in every case, but say it's a large borrower and there's a shortfall for NWC, then this long-term funds, corporate loan is a term loan. Okay, so this long-term funds will be shoring up the NWC. Okay. Because basically it's a long-term fund, so long-term funds will be improving the NWC position. So there could be a variety of reasons why this is not the only reason why it's given. There could be a variety of reasons. So please go to this section if you're interested. The negotiation and discounting of bills. So you can see this section for details on bill finance. Okay, bill finance is something that banks do a lot. Okay. So you can go through this. Deferred payment guarantee it's not something you're going to see it, not going to come across very frequently, but will give you an idea about what this facility is. Securitization is a sort of an advanced concept, but still I would advise you to maybe it's something not you will encounter regularly. Then it's a very interesting topic, right? It will be very beneficial even from a point of view of interviews. It will help you, right? Share warrant, again an advanced topic, but then for a listed company, right? That has shares. Okay, it's a public limited company. This is one of the This is one of the instruments that you need to be aware of. Okay. Uh, if you're interested, you can go into it. It's an advanced topic, right? SIG company, again, SIG company is something you might come across a lot. So there's some criteria for classification of a company as SIG company. Okay. So if the accumulated loss is greater than the net worth of the company, right? So if the capital is totally eroded, so maybe then it will it will be classified as SIG company. So please go to the section. SPV is again is for very large projects. Okay. So it's basically a delinking the company from the project. Okay, a big company is floating a project. Instead of showing this project as part of the company, it will be floated as a separate SPV, right? So what happens is the risk gets delinked. For the bankers and the financiers, right? Uh, the finance will be having recourse to only the assets of this SPV. Anything happens to the project, like the debt cannot be repaid, then the bankers cannot go to this company. Okay, these assets are different. So that's an arrangement. SPV it's for large projects. So further details you can read the section. Tufts again is Tufts is a government scheme. Okay, it's a technology upgradation fund scheme, usually for the textile sector, but also for jute sector. You can find further details here. Okay. Composite loan usually for small companies. Okay, for SSA borrowers you have a facility called composite loan, where the term loan and working capital will be clubbed together and sanctioned as a single limit known as a composite loan. Very usually for SME units. Okay, you can go to this section for further details. Now derivatives is an advanced topic. If you're interested, you can go to this. They'll be having you have a lot of types of derivatives, right? Something called forwards, options, swaps. Okay, advanced topic, but can go through. Then we have a small section on forward contract. So basically, it's like to protect against the exchange rate fluctuations. Okay. So say for example, you are an importer based in India, and you're importing a product from abroad. Okay. So say it's like as $100 product. Say it's $1,000 product. Okay. And on the date of when you have finalized the contract, okay, the dollar rate was around 60 rupees. So you thought it will be 60,000, and this seller has given you some credit period. Say after 30 days. Okay, so 30 days you can make the payment after 30 days. But what happened after 30 days is like the exchange rate has gone up to 65, 62. So gone up to 62. So now on that date, if you want to make the payment, this is still $1,000, but now you make a payment of 62,000 rupees. Okay, so these exchange rate fluctuations will be impacting the importer. So forward contract is a mechanism where you can sort of freeze the exchange rate. So for this, you will be paying some charges to the bank, but basically that's the concept. Okay, so please go to the section for further details. NPA, you know what NPA is, but then a non-performing asset can be of various types. Okay. So what is a substandard asset? What is a doubtful asset? What is a loss asset? So the classification you can go through. If you want complete details on NPA, what I suggest is you should actually be going to the RBI's master circular on IRAC norms. Right? This is the income recognition and asset classification norms. So every year RBI will be issuing a set of master circulars, and one of the topics is IRAC norms. So please be thorough with IRAC norms. Okay. So if you want to know about NPA. Sarbanes-Oxley Act is a US act, so you may not need to know about it, but it's a good reading, right? For bankers, I think it will make, right? I think bankers should be knowing it. So please go to that. MSME again, what goes into the classification of MSME? So there's a ceiling on investment in plant and machinery. Okay. So what is the ceiling? You can get it in the section. Then there's a types of constituents. So various types of constituents. So your advanced parties can be either a proprietorship firm or a partnership firm, right? It could be a private limited company. It could be a public limited company. So what are the advantages and disadvantages of each, and what are the points you need to look into each category? We have discussed it here. Okay. So say for example, in partnership firm, it is very important to get the partnership deed. Okay. So here in these companies, we need what is known as memorandum and article. So the various points to look into in each category. So you can get those details here. FITL is funded interest term loan. So what happens is usually if a company is in a sort of a problem and cannot pay the interest, you can convert that interest, that accumulated interest which the company has not paid in, and you can convert it into a term loan which is repayable in say the next 2 years or 3 years. So that details you can find it in FITL. This is a facility usually given when the company is not doing too well on the repayment front. Okay. SOD we have discussed earlier. SOD is secured overdraft. This is a facility extended against this is extended against some security. This is done when usually the primary security cannot be identified. Say the case of contractor. So in the case of contractor executing some government work or say a road work, now what is the primary security there? You cannot. There is no a primary security sort of like, because the work will be constructed and handed over to the client. Okay, so this is a government department. So the road will be constructed and sort of handed over, no, or a bridge will be constructed. Right? So in some cases the identification of primary security will be a problem. So similarly in case of builder, okay, a builder will be constructing the flat, okay, and be handing it over to the customer. Right, so in those sort of situations we have something called SOD. Okay, then default release is something I think most of you must be doing it on a daily basis. So whenever you are about to sanction to a company, you check up in what is known as a default release. So RBI will be issuing this default list, willful default list. There's something called caution list. Okay, default list, willful default list. You also go through what is known as ECGC, SAL. That's the specified approval list. Right, CIBIL, suit filed account. So the various lists that you need to go through before sanctioning a limit to a company, so to check whether the company appear and or its directors appear in any of this list. So that is something you'll be doing it on a daily basis. Shares of company security, usually this happens for very large companies, where usually when you think of security, you think of land and building, or some properties where the company will be offering or the directors will be offering a security. But sometimes the shares of the company themselves can be offered as security. But then there are certain guidelines, say there is a section 19.2 of the Banking Regulation Act, which stipulates that ceiling is say 30%. So 30% of the paid up capital of the company cannot, more than 30% of the paid up capital of the company cannot be offered as it's like basically what this section says is no banking company can take as pledge or as security. There's a lengthy definition. Basically the ceiling is 30%, right? So bank cannot take more than 30% of the paid up capital of the company as the security. So please go to the section for further details. There's documentation. Documentation comes after sanction. So what are the aspects you need to look in? Documentation is provided in this section. Something called prepayment charges. You must be aware of that. Basically, if a company prepays the loan, usually banks will be stipulating some prepayment penalty, say 2% or 3% or 4% of the outstanding. So this again depends from varies from bank to bank. There's the prepayment charges. Then there is a credit discipline, credit summations. So you want a healthy account. In a CC account, what you basically want is there should be healthy operations. You don't want only drawings, only debits and no credits. Okay, so you want a healthy inflow and outflow. So basically banks check what is known as credit summations, right? So say for example, one full year from the balance sheet you will be having the turnover, the sales. Okay, so then they'll be adding up all the credit summations in the account. This is in the account. Okay, this is in the account, and then they'll be sort of matching this turnover with the credit summation. So basically what you want is these two to be equal. So if the company has routed its entire turnover through the account, you will find the credit summations to be almost equal to the turnover. So if it is not, maybe the company is not routing, so the company is not routing entire turnover to the bank. So you can go through this section. External credit rating for usually, so this is a emerging topic now. So external credit rating agencies like CRISIL, you have CARE, you have ICRA, Fitch, all these are external rating agencies. So beyond a cutoff, say 10 crores or 50 crores, 50 crores anyway it's mandatory. But even for smaller borrowers, banks are insisting on external credit rating. So this is an independent credit report issued by these agencies. So that will be a supporting a document to the bankers. So companies, if they get a good rating, they can bargain with the banks for a reduction rate of interest, right? So you can go through that section here. Altman Z score, you will not be using it in your career, right? So this is an advanced topic, but right, if you're interested, you can go through it. So it's like try to predict which companies might default. So this is a very interesting topic, right? Banks are worried about NPAs, PNPAs, but what if there is a formula, sort of a formula, where you can predict which companies might default? Right? Is there a sort of a formula, like say for example, some formula 1.5 times of turnover plus 60 times of profit minus 6 times of current ratio, some formula, and if it is, and because all these are available to us from the balance sheet, can we have a formula which if we substitute these parameters, it will be giving some number. This for a company A, this is, say for example, for a company A this is 1.2, for another company this is 2.5, for another company is 4.1. So can we predict? So if it's got a very high score, this company is not going to default. This is a good company. This is an average company. This got a low score. this might default. So wouldn't it be nice if we have a formula which can predict which companies might default? So basically that is the attempt of this Altman Delcias code. Actually, it uses an advanced statistical concept called discriminant analysis. Okay, this actually Altman Delcias code is not a new thing. Okay, it's some decades back it was developed by Altman, but it's an interesting reading. You can go to this section here. But it would be very nice if you have such a formula. It's not that it works 100% of the time, nor it is applicable in the Indian context. In Indian context, we have some variations proposed by some academicians, but basically that's the logic. Okay, we're trying to predict which companies might default. So we have a section on industry. So we also have a section on industry ceilings. Basically, this will be issued by a CMRD. So for every year, the your CMRD department will be coming up with ceilings. So for these sectors, for petrochemical sectors, this is the maximum exposure we're taking for the bank as a whole, right? So every sanction you have to report to your head office, even within your powers, even with the powers of branch or zone office. So they'll be consolidating all the sanctions industry wise. And if the cutoff is exceeded for this year, say by December itself, it is exceeded. So in Jan, Feb, March, they'll maybe sort of stop sanctions to this sector. So it can happen, right? So that is industry ceilings, solvency certificate. A lot of companies do approach, right? Banks for solvency certificate. So this section discusses how to calculate it. Provisions is again an account, is related to accounts. Provision, income recognition, inventory valuation, all this financial leverage, all debit credit, all these are related to accounting. If interested, you can go through. Okay. So inventory valuation, you need not be very thorough with it, but at least be aware of the terms. Like you'll be using the terms called FIFO, LIFO, first in, first out, last in, first out. So based on this, the valuation can change, right? And this will be affecting because for banks, inventory is very important because you calculate DP. Just by changing the inventory valuation method, you can arrive at a different stock value, right? And based on the DP will change. So you should be aware at least of the terms, what this means. Financial leverage is basically the comfort that debt provides. It's a mix of financing, the proportion of mix of equity and debt. And the advantages debt provides, right? A bit of advanced financial management topic, but all these are accounting and financial management issues, right? Then we have a section on high sea sales. So say for example, you want to import a log, from Malaysia. Okay, so Malaysia, this is common in countries of the Southeast Asia, right? So in India, as a Supreme Court directive, it is not permitted, but in Malaysia, a lot of forests and logs are. A lot of Indian companies import logs from Malaysia. So say for example, you are a plywood manufacturer in India and you want to purchase logs from Malaysia. Now, one option is to order it directly from the Malaysian supplier, but that's very expensive because only for you he has to ship it. There will be a lot of shipping costs, so that's expensive. So one thing you can do is you can purchase it from a dealer, right? So this dealer, he's a dealer in plywood. Right, he'll be having a lot of Indian customers, all of them who wants plywood. So this party as a whole imports from Malaysia and then be selling to the local party. So this is a cost-effective solution. But the problem here is there is a cost involved here. So look at the cost. This dealer has to pay customs duty because it's an import. Okay, this import from Malaysia has to pay customs duty, and then say for example this dealer is in Chennai, and the party say is in Bhopal. So what happens? He has to pay the customs duty, and then this Bhopal party, when he purchases from this Chennai, from the dealer, there'll be a sales tax because it's an interstate transaction. Even if it's a local transaction, there'll be a sales tax. So there'll be two costs involved. One is the customs duty and the sales tax. And ultimately, all costs are passed on to the party. The dealer will not be absorbing the cost. So ultimately, it'll be expensive for the party, Bhopal party. So alternative could be, so when the ship leaves Malaysia, right? When the ship leaves Malaysia, it's in the high seas. This term is high seas. Okay, the ship is still in the waters, high seas. It is not reached India. It's not reached Chennai port. It's in the waters now, but it has left the shores of Malaysia. Okay, so it's in high seas. Okay, now here the Bhopal party, the Chennai party, there's a dealer can sell to Bhopal, can sell to the Bhopal party when the goods are on high seas. This is possible. Right, by suitable endorsement to the documents. So this can be done. Now the advantage of this is once the material comes to the shores of India, anyway customs duty has to be paid. That cannot be avoided. Okay, customs duty has to be paid. But then sales tax need not be paid by the Bhopal party because it is now not a sale. This belongs to the Bhopal party. there's no sale here involved. It's basically a transfer of stock from Chennai to Bhopal. So that will be avoided. The sales tax will be avoided. So it will be cost effective for the buyer. Okay. Then we have a section on certification by professionals. Usually banks insist on various certificates. Like say for example from engineer, it might insist on what is known as a valuation report for collateral securities now. Okay, valuation report. Then there will be legal audit. Usually bank will be having their internal legal experts, but sometimes panel advocates will also be there. Okay, for small limits. Then there will be a chartered accountants. Okay. They'll be supplying a lot of certifications like regarding the funds infused by the promoters and various other certificates. There could be a lenders engineer, independent engineer. So the various independent professionals, these are not employees of the bank. These are external independent professionals, and banks rely on the information, on the certifications provided by them for taking certain decisions. So now you'll be very careful, because if there is a sort of a tie-up between the party and these professionals, and that is usually the case, okay, so you will not be getting the correct information, right? You might be taking some incorrect decisions. So there are some guidelines, right? So there are some guidelines, so you can go to this section. CGTMSE, it is collateral free credit. So for small borrowers, availing limits up to 1 crore. This is for MSME borrowers. Okay. Up to 1 crore, there is a scheme called CGTMSE. So you can refer to the details here. So it's a good scheme. Banks are encouraging sanctions under CGTMSE. So the advantage here is there is no collateral security required, no guarantors. Okay. So in case the loan goes bad, the CGTMSE will be reimbursing the bank. There is a restriction, 65% or 75%. Some not the entire outstanding, not the entire exposure, but then it's a good alternative, because there will be many first generation entrepreneurs who cannot provide collateral securities. Okay, so this is a nice facility. Then there are various bank charges and credit. So I have listed a few. You will be aware as a banker. So there will be processing charges. There will be upfront fee for term loans. For BGs and LCs, there will be something called commission. So various charges are there. Okay, there will be prepayment charges in case of term loan. Various charges, you can go through this section. Takeover of credit facilities is very important. You should definitely go through this. It's like it happens when a company is availing facilities from say one bank, say Oriental Bank of Commerce, and the Indian bank takes over this account. So what it means is, say this company is availing a term loan, the present outstanding is 100 lakhs. So Indian bank will be sanctioning a facility, a term loan of 100 lakhs. With this 100 lakhs, OBC account will be closed, right? And it will be transferred here. So Indian bank will be, so the funds will not be released to the company, it will be released to the bank. With that, this OBC facility will be cleared. Now the company will be having exposure with Indian bank. Now takeover is you have to be very careful, because it could be possible that the company is not doing well in one bank. In bank one, it is not doing well. Maybe the bank is pressurizing this company. You're not following a guidelines. Your turnover is not good. Your operations are not good. This company wants to get rid of all this headache. Then it goes to another bank. Now bank two, why would bank two take such an account? Now here lies the problem. Bank one wants to get rid of this somehow. So they'll be issuing a satisfactory PNC report. So as per guidelines, RBI guidelines, before takeover, this bank should insist on what is known as a credit opinion or a PNC report. Credit opinion report or a PNC report. Basically, this is a opinion report from the bank one. So how the conduct of the account is. Now usually, even if the account is not doing well, the banks because they want to get rid of this party, they'll say it's a satisfactory, and then they'll be issuing the certificate. Now bank two will be taking over this account, and then it will realize that it's not a good account. But then takeovers are happening very aggressively, because it's an immediate way of increasing advances. Normally, if you issue a term loan disbursement will be in phases, okay? Because you give the advance for a project. Say the execution time is 6 months or 1 year. So a project of say 10 crores, it's not going to be released immediately, right? Say you are in February 2013, right? 10 crores will not be released straight away. Say 2 crores will be released in February and March of this year, and next financial year the balance 8 crores will be releasing. But as a banker, if you are interested in your targets, advanced target, this is not a great scenario, right? But takeover is not like that. Takeover, immediately, instantly, your advanced portfolio will grow up. Right? There's no phase-wise disbursement, because you'll be closing the account of the other bank by immediate disbursement. So there's an incentive for banks to reach their advanced target by takeovers, but then you have to be very careful. So what are the guidelines? RBI takes a serious look into takeover accounts. If there's a inspection, RBI inspection at a branch level or zonal office, head office, takeover accounts are pursued very carefully by RBI inspector. So please be careful. Please go to this section. has got a lot of interesting points. CERSA is a very good initiative by the government to basically avoid multiple lending, right, on the same security. So in the same property, this was a problem that was happening, right? On the same property, various banks were issuing because of lack of information exchange between them. So now CERSA is a very good process that will counter this. Okay, right? That is being done by banks these days. So you need to know about that. Cooperative versus guarantor, there's a difference, right? So you must be aware of this difference. So guarantor is like basically saying if this account goes bad, I will step in and I will clear the debt, something like that. Co-applicant is different. Co-applicant is not a guarantor. He's like applicant 1 and applicant 2, right? So both of them are equally responsible for clearing this account. It's not like guarantor. Guarantor is a sort of a secondary mechanism. Okay, there will be main applicant and then there will be a guarantor. In case the applicant is not able to clear the debt, guarantor will be stepping in. But co-obligation is different. Co-obligation is both are applicant 1 and applicant 2. Usually you have husband and wife. To a housing loan, you can have a husband and wife as a co-applicant. Okay. Pledge versus hypothecation is a difference which you must be aware as a banker. So pledge means the whatever is the security will be lodged with the bank, right? So pledge of gold ornaments for gold loan. Okay. So the security will be lodged with bank. Right? So it will be possession of the bank. So in case the account goes bad, you can say sell off the assets. If it's a gold loan, you can sell off the gold ornaments and recover your debt. So that's an advantage. Hypothecation is like the property is not lodged. Say for example, you have given a finance for a auto rickshaw, right? So usually you will see this, right? Behind the auto rickshaw, there will be written something. This is hypothecated to Canara Bank. No, it will be written. So basically, hypothecation is the possession of the property will not be with the bank. The borrower will be having the possession. So the risk is he can sell off this without bank's knowledge, right? So that is a risk. Okay. So you will be coming across these terms very frequently. Okay. So in terms of project finance for land and building, we use the term mortgage. Okay, equitable mortgage. If you want to stipulate in the security in the sanction letter, we'll be saying equitable mortgage of land and building. Land and building are mortgaged. Okay, and then hypothecation of plant and machinery and other fixed assets. So this is the terminology usually that is used. Okay, so plant and machinery hypothecation means this will be the factory premises, not with the bank. Okay, so the possession will be the company. Mortgage is different. Mortgage is like the title documents for the land will be lodged with bank. Okay, so various security terms that you need to be aware of. That brings us to the end of this chapter. I have sort of rushed through the various terms, but if you're interested in exploring a particular topic further, you can refer to the book where we have a detailed discussion of each of the 60 terms. Okay, so with this we come to the end of this chapter. In the next chapter, that's the final chapter, chapter 17, we'll be discussing about the checklist. Okay, so if a proposal comes to you, what are the aspects that you need to look into? What are the documents you need to insist from the borrower? Just a sort of a checklist. Okay, so this will guide you when you get a new proposal. This will be bifurcated into term loan and OCC. So if it's a term loan proposal, what are the documents you need to get? If it's OCC, what are the documents you need to get? What are the aspects you need to look into? So that I'll provide a comprehensive checklist in the next chapter. Okay, so see you then.